All right, let's get right into it. We are breaking down Whirlpool's Q3 earnings report. And after a really brutal year for the stock, the big question on everyone's mind was simple. Is this the quarter they finally turn things around? So just to set the stage for you, this stock has been getting hammered, down over 25% in the last year. Sentiment heading into this report was, well, it was in the gutter, especially after they cut their outlook and their dividend back in July. Yeah, the market was absolutely braced for the worst. But then the numbers dropped. And wow, a massive beat on the bottom line. We're talking non-GAAP earnings per share of $2.09. Now, Wall Street was only expecting about $1.39. That is a 70-cent beat, a huge surprise that you better believe got the market's attention immediately. And the surprise didn't stop with earnings. Nope, they also beat on the top line, on revenue. They brought in $4.03 billion, which was a good $100 million more than expected. And here's the really crucial part. That's 1% growth year over year. It doesn't sound huge, but it completely reverses a really nasty negative trend. That is a big deal. So how did the market react to all this? Pretty much exactly as you'd expect, very positively. The stock jumped over 5% that morning. But what's really telling is the volume. Trading activity surged to almost 200% of its normal average. That tells you this wasn't just some small pop. There was real money and real conviction behind this move. This was the absolute definition of better than feared. Okay, so with that huge positive reaction, you might be thinking, great, it's all good news. Well, not so fast. When you start to peel back the layers here, the story gets a lot more complicated. It's really like you're looking at two totally different businesses operating under one roof. And this chart right here, it illustrates the point perfectly. Look at this. All of that top-line growth we just mentioned came from their main market, North America, which was up almost 3%. But at the same time, the international picture was weak. Latin America, down over 5%. Asia, down more than 7%. I mean, that stark contrast is the central theme of this whole quarter. So let's put the good and the bad right next to each other. On one side, you've got a solid revenue story, all driven by that North American strength. But on the other side, oof, the profitability picture is much, much tougher. Their core profit margins got squeezed, their actual profit fell over 22%. And look at that free cash flow number. They burned through over $900 million in just 3 months. This right here is the core tension investors are trying to figure out. So, given this really mixed picture, what is management's plan, right? How are they going to use that strength in North America to fix the weaknesses everywhere else? Let's break down their playbook. The main part of their strategy, the centerpiece, is all about innovation. The CEO just kept hammering this point home on the call, calling it a record year of new product launches. And look, this isn't just corporate speak. It is actually translating into them gaining market share and getting more floor space with retailers, especially in the US. I mean, think about it, the first major KitchenAid refresh in a decade. That's what's driving so much of this momentum. So it really is a two-handed approach. On one hand, they're pushing for growth with all that product innovation we just talked about. On the other hand, they're playing defense, aggressively cutting costs, trying to save around $200 million in 2025. And finally, they're looking down the road, expecting some of the competitive pressures from tariffs to start easing up as we get into 2026. And finally, they're looking down the road, expecting some of the competitive pressures from tariffs to start easing up as we get into 2026. Okay, so that's the strategy. But how will we know if it's actually working? We're tracking 4 key things, 4 catalysts that you absolutely need to have on your radar for the next few quarters. First, promotions. As their competitors sell through old inventory, can Whirlpool finally pull back on all the discounts? Second, those North American profit margins. Can they recover once the one-time costs of all these product launches are behind them? Third, we're keeping a close eye on their factory expansion in Ohio. And finally, and this one is a big one, can they actually deliver on their full-year free cash flow guidance of around $200 million after burning through $900 million in Q3? That will be the real test. All right, let's put it all together. This is The Next Call, where we give you our take on what to expect. Here is our forecast and our final rating for Whirlpool stock. For Q4, we're calling for earnings to be pretty much in line with what the street expects. That product momentum should continue for sure, but we think those margin pressures are going to stick around. On revenue, we're looking for a slight beat, mostly because the holiday season and new products should keep driving those North American sales. But what about the stock price? We see it as range-bound. The market has already priced in the better-than-feared news, and now it's basically in wait-and-see mode for proof that those catalysts are for real. Which brings us to our final rating, market perform. The bull case is clear, that product momentum in their most important market provides a solid floor under the stock. But the bear case is just as clear. Those nagging margin pressures and cash flow uncertainty are going to cap the upside, at least for now. The risk and the reward just feel pretty balanced right here. And a final reminder, as always, this is not financial advice. Please be sure to conduct your own research before making any investment decisions.